Welcome to our deep dive today. We're going to be taking a look at Warren Buffett's 2002 letter to Berkshire Hathaway shareholders.
Okay.
And you've sent over some really interesting stuff, excerpts from the letter itself.
Yeah.
And a document that seems to pull out some of the key themes. Now, this letter, this is right after the dot-com bubble burst.
Right.
So it's like a fascinating snapshot of how Buffett was thinking during that really turbulent time.
Yeah, for sure.
And as we'll discover, a lot of what he was saying back then still rings true today.
Yeah, definitely.
So are you ready to dive into Berkshire's performance?
Sure.
Those intriguing acquisitions he made, his take on corporate governance, and that now famous warning about derivatives.
Absolutely. Let's get into it.
Okay, so let's start with Berkshire's performance in 2002.
Right.
A whopping 32.1 percentage point outperformance of their book value compared to the S&P 500.
Yeah. That's insane, right?
Yeah, it is quite a feat. But it's important to note that Buffett himself acknowledges that 2002 was an unusual year, with several factors contributing to this success, this kind of extraordinary success.
Right. He actually goes through this normalizing process with the earnings.
Yes.
Right. Stripping away the lack of a major catastrophe and some gains from bond strategies. Almost like he's trying to take luck out of the equation.
Precisely. That's classic Buffett.
Yeah.
Transparency and managing expectations.
Yeah.
He consistently emphasizes that, he and Charlie Munger, they're not aiming for these massive wins every year. Their goal is consistently outperforming the market by a few percentage points over the long haul.
Okay. So it's interesting, though. Why do you think he goes to such lengths to emphasize the role of luck and downplay these big wins? I mean, most CEOs would be shouting that 32.1% from the rooftops.
Well, I think it's all about setting realistic expectations for shareholders.
Okay.
Buffett understands that sustainable success isn't built on chasing short-term gains.
He's reminding everyone that, look, even Berkshire's performance has its ups and downs.
Right.
You can't expect to hit a home run every time.
So, a lesson for us all then. Stay focused on the long game and don't get too caught up in the hype of any single year's performance.
Right.
Now, let's shift gears a bit and talk about those acquisitions Berkshire made in 2002.
Okay.
There were quite a few additions to the portfolio.
Yeah.
Some more intriguing than others.
Yeah, definitely.
Wouldn't you say?
Absolutely.
Yeah.
This is where we really start to see the hallmarks of Buffett's investment philosophy in action. He's drawn to businesses with a clear competitive advantage, something he often refers to as a moat.
Yeah.
And of course, he wants strong management in place, leaders who think like owners.
Okay, so let's talk about one specific acquisition, the Pampered Chef.
Okay.
Now, I have to admit, when I first saw this on the list, I thought,
Yeah.
really? Kitchenware?
I know what you mean.
But then I started digging into their business model, and it's pretty fascinating.
It is. It's a brilliant example of how a simple idea, when paired with the right execution and a unique distribution model, can create a remarkably successful business.
Yeah, tell me more about that. What did Buffett see in the Pampered Chef that just screamed moat to him?
Well, think about it. It's not just about selling high-quality kitchenware.
Right.
Doris Christopher, the founder, she had created this network of independent consultants who sold directly to customers through home parties.
Right.
It's a system that built trust and personal relationships.
Okay.
And that's really hard to replicate online.
So their moat wasn't just the product itself, it was that whole ecosystem they built around it.
Exactly.
That makes a lot of sense. And what's amazing is that Doris started this business with just a $3,000 loan
I know, right?
against her life insurance policy.
Yeah, it's incredible.
And by the time Berkshire acquired the Pampered Chef, it was a $700 million company. That's right. It's like that entrepreneurial spirit, coupled with that sustainable competitive advantage, that's exactly what Buffett looks for.
Absolutely.
Now, the Pampered Chef is a fascinating example.
Yeah.
But there were other acquisitions that year too, right?
Right.
I'm looking at this list. Albeca, Fruit of the Loom, CTB, Garon.
Each one tells a story about Berkshire's strategy. Like, take the case of Northern Natural Gas Pipeline.
Okay.
Its journey is fascinating. It began right here in Omaha.
Oh, wow.
Was absorbed by Enron, used as collateral by Dynegy during their, tumultuous period.
Yeah.
And then in a remarkable twist of fate, it ended up back in Omaha under Mid-American Energy Holdings, which Berkshire controls.
Wow, it's like a prodigal son story.
Exactly.
Yeah.
That's crazy.
And this really speaks volumes about Buffett's opportunistic approach and long-term vision. He's not just buying businesses for a quick flip.
Right. He's identifying companies that he believes will be valuable for decades to come.
So it's that buy and hold mentality that's, kind of synonymous with his approach.
Exactly.
Okay, let's move on to another core element of Berkshire Hathaway, insurance.
Okay.
I know this can get kind of complex.
Yeah.
But I'm hoping you can break it down for us a little bit.
Sure.
So what was Buffett's take on the insurance side of things in 2002?
Well, when it comes to insurance, the concept of float is key.
Right.
In simple terms, it's the money Berkshire holds from premiums paid by policyholders, but hasn't yet paid out in claims. It's not their money, but they get to use it.
Yeah.
The brilliance lies in how they utilize that float.
So it's like having this giant pool of money that they can invest.
Exactly.
But the trick is managing it effectively.
Right.
And I'm guessing that's where the cost to float comes in.
You got it.
Yeah.
Cost of float is essentially the cost of holding and managing that float. It can make or break an insurance business.
Okay.
In 2002, Berkshire achieved an incredibly low cost of float, around 1%.
Wow.
But as always, Buffett injects a note of caution.
He always wants people to be,
right,
grounded.
He doesn't want people getting carried away.
He's always thinking about those potential downsides.
Exactly. He points out that, 2002 was a relatively calm year without any major catastrophes.
Right.
And those catastrophes, as we know, are inevitable in the insurance business. They can send those costs skyrocketing.
Right.
So he's always preparing for them.
Always thinking long term, even when things are going well.
Right.
Now, speaking of managing risk, let's get into one of the most talked about sections of this letter.
Okay.
Buffett's warning about derivatives.
Yeah.
He didn't mince words, did he?
No, he did not.
Calling them financial weapons of mass destruction.
Right, and this was years before the 2008 financial crisis, which many believe was exacerbated by the widespread use of derivatives.
It's a testament to his, ability to see risks that others often miss.
Definitely.
But what exactly are derivatives?
Okay.
Can you break it down for us in a way that, even someone who's not like a finance expert can understand?
Sure. Imagine betting on a horse race where the odds are constantly changing.
Yeah.
And can be manipulated by insiders. That's kind of a simplified way of thinking about derivatives.
Right.
They're contracts whose value is derived from something else, like the price of oil or interest rates or even the weather.
Okay, so I'm starting to get the picture a little bit.
Yeah.
But what makes them so dangerous? I mean, I know they can be used to hedge against risk, right?
Yes, but the problem is that they can also be used to amplify risk, often in ways that are hidden and difficult to understand.
Okay.
Buffett's concern was that these instruments allowed for excessive leverage and created a system where losses could cascade through the financial system.
And remember, this is a man who was famous for saying, rule number 1, never lose money.
Right.
Rule number 2, never forget rule number 1.
Exactly.
So anything with the potential for these huge, unpredictable losses is going to be a red flag for him.
Precisely.
Yeah.
And he uses the example of long-term capital management, that hedge fund that nearly brought down the entire financial system in 1998, as a cautionary tale about the dangers of, unchecked derivatives trading.
It's almost like an I told you so moment for him.
Right.
But it's not really his style to gloat.
Right. No, not at all.
Yeah, it all circles back to his desire to build Berkshire into a fortress.
Yes.
Financially speaking, right?
Exactly.
He doesn't want to play with matches.
Right.
Even if everyone else is.
Yeah, he's all about protecting Berkshire's long-term stability.
Right.
And that means avoiding anything that could jeopardize that, even if it means missing out on some potential short-term gains.
Which brings us to another theme that's central to this letter, corporate governance.
Okay.
What stood out to you about Buffett's discussion of this topic?
Well, what's striking is his palpable frustration. with the state of corporate leadership, particularly in the aftermath of the dot-com bubble and the accounting scandals that followed. He's calling out the erosion of ethical behavior, especially among CEOs.
Yeah, and he doesn't hold back on his criticism of those boards that enabled this behavior, does he?
No, he does.
Especially those, quote-unquote, independent directors.
Right.
Who weren't quite as independent as they seemed.
Yeah, he's very clear that true independence requires more than just meeting the legal definition.
Okay.
He believes directors need business savvy, a genuine interest in the company, and a deep commitment to representing shareholder interests.
He even tells that story about his own daughter being offered a lucrative directorship and turning it down because she didn't feel she could be truly independent.
It's a powerful anecdote that highlights how personal integrity is at the heart of good corporate governance.
Yeah, and then there's his critique of CEO compensation.
Right.
He is appalled by these exorbitant pay packages.
Yes.
Especially those that are awarded for, pretty mediocre performance. He's basically calling for a boardroom rebellion against this trend.
He's challenging boards to stop rubber stamping these, outlandish pay deals and start using their own judgment instead of blindly following consultants who have a vested interest in keeping CEO pay high.
What do you think it is about inflated CEO compensation that bothers him so much?
It boils down to a misalignment of incentives.
Okay.
If a CEO's pay is completely decoupled from the company's performance and shareholder value creation, what's motivating them to act in the best interests of the company?
He even goes a step further and suggests that directors themselves should be paid modestly.
Yeah.
So their decisions are driven by what's good for the company's value.
Right.
Not just by their own director fees.
It's a provocative idea, but it makes you think, doesn't it?
It does.
It all ties back to his philosophy of, aligning interests and fostering a sense of ownership at all levels of the company.
So we've got Berkshire's performance, those insightful acquisitions, and Buffett's pretty strong opinions on corporate governance. I'm ready to delve deeper into his investment philosophy in 2002.
Okay.
And that warning about derivatives. Are you ready to continue this deep dive?
Absolutely. Let's pick up where we left off after a quick break.
Welcome back. Now, after the dot-com bubble burst, a lot of investors were probably scrambling, trying to figure out what to do next. So what was Buffett's investment approach during this time? Was he like buying the dip, or what was he doing?
Well, despite the market downturn, Buffett remained cautious about equities in 2002. He just wasn't finding many companies that met his strict valuation criteria.
So was he just like sitting on his hands then?
Well, not entirely. He was strategically deploying capital, but in a way that reflected the market conditions. He found opportunities in a few select junk bonds and loans.
Junk bonds? That doesn't sound very Buffett-like.
Well, these are typically considered higher risk investments,
Yeah.
But he saw an opportunity because yields were attractive at the time. He believed that by carefully selecting, bonds and loans from companies with solid underlying businesses, he could manage the risk and generate strong returns.
So it's a reminder that even though he's known for that long-term buy and hold approach, he's not afraid to adapt to changing market conditions.
Exactly.
And explore different asset classes.
He's constantly seeking value, regardless of where it might be found. But he's also disciplined. If he can't find anything that meets his, stringent standards, he's perfectly content to sit on the sidelines and wait for the right opportunity.
Patience.
Yeah.
That's a key part of his success,
Absolutely.
Knowing when to act and when to hold back.
It's like that famous baseball analogy.
Oh, yeah.
Waiting for the perfect pitch.
He's not swinging at every pitch.
Exactly.
He's waiting for one in his sweet spot.
He's waiting for one right down the middle.
Right down the middle. And when it comes to finding those sweet spot investments, Buffett offers some timeless advice in this letter.
Yeah.
He highlights 3 key things that investors should be wary of.
Yeah.
So let's break those down.
Okay.
What's the first red flag he points to?
The first one is companies with weak accounting practices.
Okay.
He specifically mentions companies that don't expense stock options or use unrealistic pension assumptions.
Okay.
These are potential signs of, deeper problems lurking beneath the surface.
So if they're playing games with the numbers, be very cautious.
Exactly.
What's the second warning sign?
Unintelligible footnotes in financial statements.
Okay, so if I'm reading through a company's reports
Yeah.
and I hit a footnote that I can't decipher.
Yeah, if you can't understand what a company is saying in its footnotes,
Yeah.
it's probably because they're trying to hide something.
Transparency is key.
Exactly.
If they're not being upfront and clear about their financials, that's a big red flag.
Absolutely.
Okay, what's the third piece of advice?
The third warning is to be skeptical of companies that overemphasize earnings projections and growth expectations.
So don't get swept up in the hype.
Right.
Don't buy into those, overly optimistic projections.
Focus on the fundamentals of the business and its long-term potential.
So separate the signal from the noise.
Precisely.
Don't let those short-term fluctuations distract you from the bigger picture.
Exactly.
Now, shifting gears a bit, I want to talk about one of the really impressive figures that's highlighted in this letter.
Okay.
Ajit Jain, who heads up Berkshire's reinsurance division.
Yes, Ajit is a legend.
Buffett sings his praises, doesn't he?
Oh, absolutely.
I think he even jokes that if Berkshire were to include a photo in its annual report, it would be of Ajit in full color.
And for good reason.
For good reason. He's built an incredible, reinsurance business for Berkshire.
Yeah.
He's generated billions of dollars in float. Remember, that pool of money they can invest.
Right.
And consistently delivered strong underwriting profits.
Absolutely.
And what's remarkable is that he does it with a surprisingly small team, right?
Yeah.
Like Buffett mentions that Ajit's entire operation has only 20 employees.
That's right.
It's a testament to the power of finding those exceptionally talented individuals and giving them the freedom to do what they do best.
Absolutely.
It also speaks to the power of Berkshire's, decentralized structure.
Yes.
That hands-off approach that Buffett favors.
Right. He trusts his managers to run their businesses effectively.
Yeah.
Without interference.
Now, one particularly interesting aspect of Ajit's reinsurance business is his involvement in retroactive insurance.
Yes.
Retroactive insurance.
Yeah.
That sounds kind of counterintuitive.
It does, doesn't it?
Isn't insurance about protecting against future losses?
Right.
Not taking on responsibility for losses that have already happened.
Well, that's what makes it so fascinating.
Okay.
Buffett explains that this approach can actually be quite profitable for Berkshire due to the time value of money.
All right, break it down for me. How can taking on past losses be profitable?
Let's say a company has a potential liability from an event that occurred years ago.
Okay.
They face the risk of a large payout in the future. Ajit and his team will assess the risk and, for a price, will assume that liability. They get paid up front for losses that may not have to be paid for years, even decades down the road.
So while they're taking on this risk, they're also getting a significant chunk of capital that they can invest and generate returns on for potentially a very long time.
It's a brilliant example of how Buffett and his team think differently about risk and opportunity.
So it's like they're getting a loan, but instead of paying interest, they're receiving it.
That's a great way to think about it.
Okay, so we've got this incredible manager running a very successful and somewhat unconventional reinsurance operation.
Absolutely.
This all seems to tie back into Buffett's bigger picture, thinking about corporate governance, doesn't it?
Yes. Remember, one of his central concerns was the lack of accountability and ethical lapses he saw in corporate America.
Okay.
He felt boards weren't doing enough to hold CEOs accountable and that too much power was concentrated at the top.
So he's advocating for that more decentralized structure where talented managers like Ajit Jain are given the freedom to operate independently.
Exactly. He's saying find the best people and let them do their thing.
Right, but he doesn't stop there.
No.
He also goes on to criticize what he sees as a weakening of accounting standards.
Yeah.
And the undue influence of corporate lobbying on the rulemaking process. So let's talk about that a little bit. What are some of the specific issues he raises about the accounting landscape?
Well, he recounts the battle over expensing stock options, which he was a strong advocate for.
Yeah.
He felt very strongly that companies should be required to treat stock options as an expense on their income statements. But they fought hard against it.
They didn't want to do it.
No.
And he wasn't shy about calling out the Senate for kind of caving to corporate pressure.
Yeah.
And undermining the independence of the Accounting Standards Board.
He was incredibly frustrated by that.
Yeah.
He saw it as a prime example of how corporate interests can distort accounting rules to their advantage, ultimately harming shareholders and eroding public trust in financial reporting.
It's a cautionary tale.
Yes.
about the importance of having strong and independent regulators who can stand up to corporate lobbying and uphold the integrity of the financial system.
He's making the point that transparency and accountability are crucial, not just for individual companies, but for the entire financial system to function properly.
So we've covered a lot of ground here.
Yeah, we have.
From acquisitions and insurance to corporate governance and accounting concerns. What a deep dive it's been.
Absolutely.
But before we wrap up, I want to go back to that warning about derivatives.
Okay.
We talked about what they are, but I'd love to hear more about why they're so dangerous.
Yeah.
Especially in Buffett's eyes. What are the specific mechanisms that make them, quote-unquote, financial weapons of mass destruction?
Let's unpack that in the next segment.
Okay.
It's a critical part of understanding Buffett's approach to risk.
Okay.
And his desire to build a fortress-like balance sheet for Berkshire.
Welcome back to our deep dive into Warren Buffett's 2002 letter to Berkshire Hathaway shareholders. We're about to uncover exactly why Buffett views derivatives as so risky. You mentioned that Buffett was particularly concerned about derivatives even before the 2008 crisis. Could you elaborate on the specific risks associated with these complex financial instruments and why they were so alarming to an investor who prioritizes stability and long-term value?
Right. So one of Buffett's primary concerns with derivatives is the lack of transparency in the market. Unlike stocks or bonds, which are traded on public exchanges with readily available pricing information, many derivatives are customized contracts traded over the counter. This lack of transparency makes it challenging to determine their true value and the risks they carry. It's like navigating a financial maze blindfolded.
Ah, I see. So it's not just the instrument itself, but the lack of visibility and the potential for hidden risks that makes them so dangerous.
Precisely. Buffett also highlighted the heavy reliance on complex mathematical models for valuing derivatives. While models can be helpful, they're often based on assumptions that can change rapidly, especially in volatile markets. If those assumptions prove inaccurate, the value of the derivative can plummet, leading to significant and unexpected losses.
And remember, we discussed earlier how derivatives often involve leverage. That means using borrowed money to amplify potential returns.
But it's a double-edged sword, right?
Exactly. Leverage magnifies both gains and losses. So if a derivative's value drops significantly due to faulty models or changing market conditions, those losses can be amplified, potentially wiping out an investor's capital.
That's a level of risk that Buffett, who famously said rule number 1, never lose money, would never be comfortable with.
It makes sense. He's built his entire investment philosophy around minimizing losses and protecting capital. Now, I remember you mentioned counterparty risk as another concern with derivatives. Can you explain that a bit more?
Sure. Counterparty risk refers to the possibility that the other party in a derivative contract may not be able to fulfill its obligations. If one party goes bankrupt or defaults, the other party is left holding the bag. This risk is particularly acute in the opaque world of derivatives, where it can be challenging to assess the financial health of your counterparty.
So even if you think you've perfectly understood and managed the inherent risks of the derivative itself, you're still exposed to the potential failure of the other party.
Precisely. That adds another layer of complexity and uncertainty. You're essentially trusting that your counterparty will be able to meet their financial obligations, and if that trust is broken, the consequences can be dire.
Especially for an institution like Berkshire Hathaway, built on the principles of stability and long-term value creation. It's clear why Buffett viewed derivatives as a threat to their fortress balance sheet.
Absolutely. Buffett saw derivatives as a ticking time bomb within the financial system, a bomb that ultimately exploded during the 2008 crisis, confirming his long-held concerns. Now, shifting gears a bit, let's move from the world of finance to another topic Buffett emphasizes in his letter, corporate governance. What particularly stood out to you in his discussion on this matter?
Well, he doesn't mince words when it comes to his criticism of corporate leaders and boards, does he? He's clearly frustrated with what he perceived as a decline in ethical behavior and accountability in many companies.
You're absolutely right. He was particularly critical of the concept of independent directors, those who are supposed to represent the interests of shareholders and provide oversight of management. Buffett argued that true independence requires more than just meeting the legal definition.
So what does he see as the hallmark of a genuinely independent director? What separates those who merely go through the motions from those who truly hold CEOs accountable?
For Buffett, a truly independent director possesses business acumen, a deep understanding of the company and its industry, and, most importantly, the courage to challenge the CEO when necessary. They aren't afraid to ask tough questions, voice dissenting opinions, and push back against decisions that they believe are not in the best interests of the company or its shareholders.
So they're not just rubber stamping the CEO's decisions, they're acting as a true check and balance, ensuring that the company is being run responsibly and ethically.
Exactly. He wants directors to act as vigilant watchdogs, not passive lapdogs. He even uses that memorable analogy of ineffective directors being like a eunuch guarding a harem. Quite a stark image.
It definitely drives the point home.
Yeah.
It's not enough to just have a board in place. It needs to be a board composed of individuals with the integrity, competence, and backbone to hold management accountable. And speaking of accountability, Buffett also takes aim at CEO compensation, particularly the excessive pay packages that were becoming increasingly common at the time.
Yeah, he saw that as a clear sign of a misalignment of incentives. He argues that when CEOs are rewarded with enormous pay packages, regardless of the company's performance or the creation of shareholder value, it encourages short-term thinking and risky behavior.
So he's essentially calling for a system that more closely aligns CEO pay with the long-term interests of the company and its shareholders.
Exactly. He wants boards to stop rubber stamping these exorbitant pay deals and start using their own judgment to determine fair and reasonable compensation. He even suggests that directors themselves should be paid modestly so their decisions are driven by what's best for the company, not by maximizing their own fees.
It's about creating a culture where everyone, from the CEO to the board members, is focused on the long-term success of the company and creating value for shareholders. Now, after all this talk about ethical leadership and corporate governance, let's shift gears a bit and revisit how Buffett was deploying capital in 2002. We discussed his cautious approach to the stock market, but I'm curious about the specific areas where he did see opportunities. You mentioned that he found value in some unconventional places.
Right. At that time, he was finding value in select junk bonds and loans. These are typically considered higher-risk investments, but Buffett saw an opportunity because interest rates were attractive and yields on these instruments were relatively high.
So even though he's known for investing in high-quality companies for the long term, he's not afraid to explore different asset classes when the market conditions warrant it.
Exactly. It highlights his flexibility and his willingness to adapt to changing market conditions. But he also emphasizes the importance of careful selection. He wasn't just buying any junk bonds. He was meticulously researching and choosing those issued by companies with solid underlying businesses and a reasonable chance of meeting their debt obligations.
So it was a calculated risk, one that he felt was justified by the potential returns and his confidence in his ability to assess and manage the risk involved. Now, we've discussed Buffett's investment philosophy, his views on corporate governance, and his warning about derivatives. But there's another element that runs throughout this entire letter, a deep appreciation for the people he works with, especially the talented managers who run Berkshire's various subsidiaries.
He speaks about them with genuine admiration and respect, highlighting their talent, integrity, and dedication to Berkshire's success. He calls them masters of their craft, individuals who operate with the same level of care and attention as if they owned the businesses themselves.
And he seems particularly impressed by their ability to operate independently, without requiring constant oversight or direction from headquarters. He's a firm believer in decentralized decision-making, trusting his managers to make the right choices for their respective businesses.
Absolutely. He uses the analogy of Eddie Bennett, the bat boy, who worked for 3 different World Series winning teams to illustrate his management style.
A bat boy. That's an interesting comparison. How does that relate to managing a multi-billion-dollar conglomerate?
It highlights Buffett's belief in the power of surrounding yourself with talented individuals and then giving them the freedom and autonomy to excel. It's not about micromanaging every detail. It's about finding the right people, providing them with the resources they need, and then getting out of their way.
It speaks to a deep level of trust and respect for his managers and a recognition that great leaders don't need to be controlling or overbearing. And this approach seems to have paid off handsomely for Berkshire, right?
Absolutely. Buffett mentions that in 38 years, not a single CEO of a Berkshire subsidiary has left to work elsewhere. That's an extraordinary statistic and a testament to the culture he's built, a culture of autonomy, respect, and shared purpose.
It's a reminder that building a successful company is not just about financial metrics. It's also about creating an environment where talented people feel valued, empowered, and motivated to do their best work. It's about fostering a culture of excellence and shared purpose.
And this brings us to the heart of what makes Buffett such an enduring and influential figure in the business world. It's not just his investment acumen, it's his commitment to ethical leadership, his long-term vision, and his deep appreciation for the people who make Berkshire Hathaway the extraordinary company it is.
It's clear that this 2002 letter isn't just a dry financial document. It's a masterclass in business, investing, and ethical leadership. It's a reminder that the principles of sound investing, ethical leadership, and long-term thinking never go out of style.
I couldn't agree more. It's a letter worth reading and rereading, as it offers timeless insights that are as relevant today as they were 2 decades ago.
So as we conclude our deep dive into Warren Buffett's 2002 letter to Berkshire Hathaway shareholders, we encourage you to reflect on the insights we've discussed and consider how they might apply to your own investment journey.
Thank you for joining us on this fascinating exploration. Until next time, keep learning, keep exploring, and keep diving deep.
And remember, the most important investment you can make is in yourself.